April 24th, 2026. The world's largest oilfield services company just reported its first quarter, beat both lines, and the stock is sitting roughly 70 cents below its 52-week high. Welcome to Charged Alpha. This is the inverse of every disaster quarter we have covered. SLB shares have nearly doubled off the 31.64 low, climbing toward 56.90. The market believes something. The question today is whether this print justifies that belief. First quarter is seasonally the weakest stretch for oilfield services. Northern Hemisphere weather, customer budget resets, project gaps, and yet SLB still delivered 52 cents earnings per share against 50.7 cents expected on $8.72 billion in revenue. That is a modest beat, not a blowout, not a shock. Stock up 2.58% on the day. The cleaner read here is execution, not surprise. The harder read is valuation. I'm Hudson Thomas.
I'm Lana Chen. Let's get into it.
SLB, formerly Schlumberger, was founded in 1926 by two French brothers who figured out how to read rock formations using electrical resistivity. A century later, that idea is still the company's DNA, turning subsurface mystery into measurable signal. Headquartered in Houston, 110,000 employees, operating in more than 100 countries. If a national oil company in Saudi Arabia, Brazil, or Norway needs to drill, log, complete, or interpret a well, SLB is almost always on the shortlist.
Revenue mix tells you the strategic shift. Well, construction is 33.9% of fiscal year 2025 revenue at $12.1 billion. Production systems, 27.9%. Reservoir performance, 26%. Digital and integration, 13.1%. That last bucket, digital and integration, is the only segment that grew last year while the three hardware segments shrank. That is the thesis embedded in the premium multiple, software-like margins layered over a global services chassis.
The oilfield services sector is a middleman business, but not a simple one. SLB does not produce oil. It provides the technology, drill bits, completion equipment, data interpretation that lets producers find and extract hydrocarbons more efficiently than they could do alone.
That distinction matters for valuation. SLB's revenue correlates with drilling activity, not oil prices directly. When operators are spending, SLB wins regardless of whether crude is at $60 or $100. The service model smooths the volatility inherent in commodity exposure.
Stock closed at 56.15, market cap 84.3 billion, beta 0.695. For an energy name, this trades less violently than the broader energy complex, reflecting the services model rather than direct commodity price exposure.
Earnings per share 52 cents, beating by 2.6%. Revenue $8.721 billion, beating by 1.1%. Year-over-year revenue growth 2.7%. The fourth consecutive quarterly earnings per share beat for SLB. Stock reaction tells the story too, up 2.58%. Not a moonshot, not a sell the news. The setup was rich, expectations were anchored, and management delivered a controlled beat into a seasonally weak first quarter. That is the pattern of a company executing on plan.
The question this episode answers, with SLB trading inches from a 52-week high and a price-to-sales ratio nearly double its closest peer, is the international upstream upcycle still ahead of us, or already in the multiple? The answer matters for anyone sizing this position today. What is striking about this quarter is the combination of signals. Stock near a 52-week high, fourth consecutive earnings per share beat, modest beat rather than a blowout, and forward estimates implying meaningful earnings per share growth in 2027. Constructive, but not euphoric, a healthy setup.
The year-over-year comparison deserves context too. First quarter 2025 was $8.49 billion. First quarter 2026 is $8.721 billion. That is a 2.7% increase from SLB's seasonally weakest quarter, steady progress without requiring a boom.
Olivier Le Peuch took over as chief executive in 2019. His story starts in 1987. As a wireline field engineer, climbing rigs, running tools downhole, reading logs at 3 a.m. in places most people cannot find on a map. He rose through every major division: wireline, testing, completions, reservoir characterization. There is no part of this company he has not touched. When he became chief executive, he did not arrive as a finance hire grafted onto an industrial. He came from inside the geology.
His strategic bet has been clear and consistent: margin expansion over volume growth. Build out digital and integration, lean into artificial intelligence-driven reservoir characterization, push autonomous drilling. The goal is to convert cyclical hardware revenue into stickier, software-like recurring revenue streams. His compensation is tied to return on capital employed and total shareholder return versus peers, exactly the metrics that punish chasing low-margin volume. The alignment is structural, not narrative. Management does not benefit from revenue without corresponding margin improvement.
Le Peuch's most visible initiative is the build-out of SLB's digital business, what became the Digital and Integration segment. When he took over in 2019, this was a collection of software tools. Today, it is a structured business generating recurring revenue from cloud-based interpretation and data licensing contracts.
The Artificial Intelligence Autonomous Drilling Program is the other concrete bet. SLB's system has reduced well construction time by 15 to 20% at early customer deployments. That translates into cost savings for operators and pricing leverage for SLB, the kind of win-win arrangement that builds durable, competitive moats in services markets. Trailing 12 months revenue $35.95 billion, net income $3.305 billion, trailing 12 months earnings per share $2.74, operating cash flow $6.49 billion, capital expenditure $1.69 billion, free cash flow $4.795 billion.
Margins tell the cyclical story. Fiscal year 2023 gross margin 18%, the high water mark. Fiscal year 2024 16.5%, fiscal year 2025 15%. Compression as international pricing reset and North America softened. Trailing 12 months gross margin now 13.6%.
Quarterly revenue trend: first quarter 2025 $8.490 billion, second quarter $8.553, third quarter $8.928, fourth quarter $9.745, first quarter 2026 $8.721. Fourth quarter is the seasonal peak. This business compounds on an annual view. Free cash flow is even more seasonal than revenue. First quarter 2025 generated only $262 million. Fourth quarter generated $2.489 billion, nearly 10 times higher. Modeling SLB on a single quarter produces the wrong picture. The trailing 12 months unit of analysis is what matters.
Balance sheet is the quiet superpower here. Cash $3.387 billion, total debt $11.608 billion, net debt $8.221 billion, net debt to EBITDA 1.30 times. That is conservative for any large industrial and orders of magnitude from the leverage of a distressed cable operator. Interest expense $580 million on $12 billion of debt, manageable. SLB has cushion to ride cyclicality, fund buybacks, raise dividends, and pursue technology acquisitions without straining the capital structure. The balance sheet is not a constraint here. It is an option on the next move.
The income waterfall for the trailing 12 months: revenue $35.95 billion, gross profit $4.889 billion at 13.6% margin, earnings before interest and taxes $5.320 billion at 14.8%. EBITDA exceeds gross profit here due to segment-level accounting. Annual earnings per share trend tells the full cycle story. Fiscal year 2022 $1.79, 2023 $2.60, 2024 $3.13, the peak, 2025 $2.80, the pause year, 2026 estimated $2.58 before recovering to $3.33 in 2027 and $3.77 in 2028.
Return on equity 12.8% trailing 12 months. Enterprise value to EBITDA 12.9 times, corrected from the distorted FMP metric, which showed a false zero for the most recent quarter. Price to book 2.20 times on total equity of $36.5 billion.
Forward estimates: second quarter 2026 revenue $8.793 billion, earnings per share 59 cents. Full year 2026 revenue $35.8 billion, earnings per share $2.58. Full year 2027 jumps to $39.1 billion revenue and $3.33 earnings per share. That is the embedded bet. The Street is modeling roughly 9% revenue growth and 29% earnings per share expansion in 2027 as digital and integration scales and international activity accelerates. If those numbers print, today's multiple compresses meaningfully on its own without requiring a re-rating.
14 analysts cover SLB, 11 buy or overweight, 2 hold, 1 sell. Consensus rating, strong buy, mean price target $63, implying 12.2% upside from 56.15. The narrative is clearly on the bull side of the table, but that itself is worth noting. At the high end, JP Morgan 65 overweight, Citigroup 64 buy, Piper Sandler and Morgan Stanley both at 63 overweight, Goldman Sachs and Barclays 62. These are the desks that believe the international upcycle has multiple years of duration remaining.
In the middle, Jefferies 61, BMO and Bernstein 60, Susquehanna 58, KeyBank 56. Sector weight, effectively saying it is fairly valued here. UBS sits at 52, neutral, essentially saying the move has already happened and incremental upside is limited from the current level. The outlier, Freedom Broker at 45 with a sell. That is roughly 20% downside, and it is the single voice arguing the international cycle is closer to a peak than a midpoint. Worth sitting with, even when the other 12 analysts disagree.
Bull case 1. Middle East National Oil Company spending is at record levels. Saudi Aramco, ADNOC, and Qatar Energy are committing multi-year development programs that extend SLB's order visibility 2 to 3 years forward. That kind of revenue visibility is unusual for any oilfield services company.
Bear case 1. Oil below $70 per barrel could trigger meaningful upstream capital expenditure cuts by both international and national oil company customers. SLB carries operating leverage in both directions, and current pricing assumes the international cycle holds at or above today's activity levels without a sustained crude correction.
Bull case 2. Digital and integration is the only segment that grew in fiscal year 2025, and it is SLB's highest margin business. Software-like recurring revenue from multi-year data licensing and cloud interpretation contracts scales gross margin as the hardware revenue mix gradually shifts.
Bear case 2. North America activity is contracting and historically offset weaker international periods in prior cycles. If the domestic buffer disappears and international rolls over even modestly, SLB loses the geographic diversification cushion that smoothed previous downturns. That structural vulnerability matters most at elevated valuations.
Bull case 3. Artificial intelligence-driven autonomous drilling systems are cutting well construction time by 15 to 20%. SLB captures a share of the productivity gains it delivers for customers. Technology becomes the moat, and pricing power compounds as customers cannot easily replicate what took decades of subsurface data and engineering investment to build.
Bear case 3. Baker Hughes, BKR, and Halliburton are competing more aggressively on price in international markets. If the 3 largest oilfield services companies start trading margin for market share in Middle East tenders, the premium SLB commands begins to compress across all of its hardware segments, not just domestically.
Bull case 4. Deepwater recovery is broadening beyond the Middle East. West Africa, Brazil, and the Gulf of Mexico are all coming back online as a separate growth vector. That geographic diversification within international reduces SLB's dependence on any single region and extends the addressable duration of the current upcycle.
Bear case 4. Geopolitical risk is non-trivial. SLB operates in Russia under sanctions complexity, with Middle East security overhang and frontier market payment risk across multiple jurisdictions simultaneously. A single escalation can take meaningful revenue offline with limited warning. The 100-country footprint cuts in both directions.
Bull case 5. Buybacks and dividend growth are accelerating as free cash flow improves with the revenue mix shift toward digital and integration. 2.05% dividend yield, 5 consecutive years of dividends. Capital return becomes a growing tailwind as the highest margin segment scales toward a larger share of total revenue.
Bear case 5. National oil companies are building in-house digital and artificial intelligence capabilities. If Saudi Aramco or ADNOC commoditize what SLB currently monetizes as high-margin digital and integration revenue, the technology premium that justifies the multiple weakens. It is a slow burn risk, but it is structural and worth tracking quarterly. On peers, SLB trades at 2.35 times price to sales, BKR, Baker Hughes at 1.45, ECAL, Halliburton at 1.20, FTI, TechnipFMC at 1.10, WFRD, Weatherford at 0.75. SLB is the most expensive name in the peer group by a substantial margin.
Growth does not fully explain the premium. SLB grew revenue 2.7% year over year. BKR grew 6, HAL 2, FTI 8, WFRD 5. The extra multiple is paid for technology leadership, global scale, and digital and integration recurring revenue, not top-line speed. That is exactly the bet the market is making.
Implied volatility around 28%, put-call ratio 0.90, slightly below 1, leaning modestly bullish. Subdued post-earnings options activity, no unusual flow, no large directional bets. The options market read this print exactly as it landed. Controlled execution, no surprises in either direction.
That is what a mature setup looks like when a stock is already near its high. Options market makers are not pricing in fireworks because the institutional buy side already has its position on. The next catalyst will be the second quarter print and the digital and integration growth rate it reveals.
Insider activity. Chief Executive Le Peuch holds performance-restricted stock units with vesting tied to return on capital employed and total shareholder return versus oilfield services peers. No open market transactions in this window. The equity structure aligns him directly with the capital efficiency metrics long-term shareholders prioritize.
Bottom line, SLB is the cleanest expression of the international upstream recovery thesis. A century-old moat in subsurface engineering, 100 countries of scale, 3 decades of subsurface data feeding artificial intelligence products, and a chief executive who came up from the wireline truck and built the digital strategy from scratch.
The numbers support the story without overselling it. Net debt to EBITDA 1.30 times, one of the most conservative balance sheets in large-cap energy services. Trailing 12 months free cash flow nearly $5 billion. 11 buys out of 14 analysts. Mean price target 12% above current price.
The cycle duration question is the one the single sell rating is asking. International upstream spending has been rising for 3 years. Capital discipline at the major oil companies means they are funding maintenance and modest growth, not a full-cycle boom. Steady activity and digital and integration mix shift is enough to compound earnings.
SLB does not need a boom to deliver. Steady international activity plus digital and integration mix shift plus modest free cash flow growth creates the earnings trajectory that investors are pricing today. The scenario that breaks the thesis is a sustained oil price decline below $70, not simply the absence of a commodity supercycle.
The premium multiple means the bar is set high, 2.35 times sales versus peers at 1.10 to 1.45, with peers growing faster at the top line. SLB must keep delivering the digital and integration story consistently, not occasionally, but every single quarter, to justify the gap.
Watch digital and integration segment revenue growth and margin contribution each quarter. Above 10% year over year with expanding margins signals the thesis is intact. Below 5% growth or margin compression would indicate the technology premium strategy is under pressure from commoditization or competition.
SLB is betting that the world's need for complex subsurface engineering outlasts every attempt to replace it with renewables and software. And so far, the geology is cooperating. If this helped sharpen your view, follow Charged Alpha and share the episode with someone who watches the digital and integration line. Until then, I'm Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.